This is our Forex blog for November 1st, 2011. And days like this where there's just strong trends that keep going and going are, absolutely the easiest days to trade until the market moves statistically too far. Our containment bands show the likely high and lows. The range projections set for daily show the likely daily high and low. And rarely do prices go beyond the one standard deviation. So on days like this, the earlier you trade, the easier it is. The later you trade, when currencies move too far, they're more likely to reverse. So above the upper or lower containment bands, you want to wait for the momentum to slow and then look for counter trend. But until the market moves too far, you can continue trading with a trend. One of the easiest ways of using our currency meter is to find, extreme strength. For example, in the dollar here at midnight. When the counter trend move happens for less time, in other words, you have maybe about 3 bars of red right here with very low intensity, that previous momentum trend is likely to continue, and it does within about 30 minutes for about an hour of time. And then you have the same pattern here. 1/3 or 1/4 the weakness compared to the strength, the trend's likely to continue. And your odds increase when the intermediate time frame trend is up. Underneath that is a daily trend. Underneath that is a weekly. I primarily focus on the weekly trend. So if I see a lot of strength, and you can see, late yesterday it started, it finally switched the weekly trend up at 12:30 a.m. today. That is a trend that is very high probability. The yen is also strong, however, the weekly monthly trend are very weak. The dollar has a weekly trend that's down. So as long as you keep seeing extreme strength followed by very little weakness, extreme strength followed by very little weakness, and it was only later in the day where there was a little bit of weakness, the strength's likely to continue, it didn't. You have extreme weakness here, then a little bit less strength than weakness. At this point, it looks like the trend is quite possibly over until you have a lot of momentum here, then very little weakness. That trend can continue. But the first time you see plus 80 weakness, usually you want to be very careful while continuing trading with the trend. So the dollar was clearly one of the strongest ones today. So let's find the weakest one. Without a doubt, the Australian. Unfortunately, the Australian has a weekly trend that is slightly up today. Last week and the week before, it was the #1 strongest currency. So the more you trade, the more days you trade in a row, the more feel you have for each currency as it stands by itself, not a currency pair, but just one currency. So even though the Australian has a lot of weakness today, you got to be on the lookout because of how strong it was over the last 2 weeks. And you can see that in the monthly trend. It is very strong still in the monthly trend. The weekly trend is still up, even though it is one of the weakest ones today. In between the Australian and New Zealand, the New Zealand has a weekly trend that didn't really switch to slightly up until 3, and starting the day off, the Australian is just barely hovering on positive territory over the last week. All right, so the Australian dollar is the #1 currency to focus on selling. The Swiss, also when you see a lot of weakness here followed by less strength, is pretty decent at this point right here. You only have 1 bar of incredible momentum. You don't know really which way it's going to go. It's kind of mixed. When you see patterns like the Australian with a lot of weakness followed by almost no strength, that trend's likely to continue, especially again when most of the longer time frame trends are down. So we'll start with a 5-minute chart. Starting the day off, you can see last night we had a narrow range pattern. Typically when narrow range patterns occur, big trends are likely to follow. The percentage win from a narrow range pattern over the previous 4 hours might be 45 to 55%. Some days it's as high as 70 or 80, and some days it works about 30% of the time. But the key is big trends develop out of these, and typically if the price is underneath the hourly, when it breaks underneath the low, you go short. You can see you got stopped out with maybe a 5 or 6 pip loss. You went short again here, you made 25 pips, and if you continue to look for sells, this is the lower containment band, which is what I was referring to as an extreme level. You can get short at and above the lower containment band with no problems. You can also short underneath the lower containment band, but I would advise no farther than 35 pips. So this is just slightly underneath the lower containment band. One of our patterns is a sideways rectangle pattern, and you can see that broke down. And the second entry pattern is a trend, a counter trend move. You wait for a counter trend move up, you draw your trend lines underneath those bars low, or you can see this came up, hit the 200-day moving average, went sideways. As soon as it broke down right here, you go short. And you always want to use your fibs to at least, at the very minimum, get out of half your trade. So as this came down and hit this level, it went a little bit farther. Most of the time, the 1.618, in my experience, 75 to 85% of the time, this is the end of the move. And as you can see here, you got a retracement out of it. And I'm going to show the range chart in a minute. The range chart is, 5, 6, 7 pips per bar. You can set that yourself. Notice this had a 38% retracement, and again, look where it went, the 1.618. So don't get greedy. When you see the 1.618 get hit, get out of half your trade no matter what, and you might want to get out of half your trade no matter. I'm sorry, you want to exit half your trade no matter what, and you probably are best off getting out of the entire thing, because usually that's your maximum profit, like I said, 75-80% of the time. And when the price is underneath the lower containment band, it's at the high end of that range. Fib targets inside the normal likely lows and normal highs can go beyond, and oftentimes go beyond, the 1.618 fib. When the price is in an extreme underneath the lower 2.0 white containment band, the 1.618 is likely to be your max profit. And the farther away it goes underneath there, the more likely the first fib target, the 1.382, is likely to be your profit target, as you can see here. The farther underneath this, and again, you probably wouldn't have taken this last trade here, because it appears that it's about 40-50 pips underneath there. That's too far. The risk is very high that the trade's not going to work. And if it does work, it's very likely to double bottom right here. In this case, it went lower. 37 was your estimated profit target. It's a 20 pip risk, 20 pip likely profit target while risking 10 pips. So it barely meets our criteria of 1.5 to 2 times better or more profit versus your risk. Now you can see also with the Trend Intensity Pro and all of our statistical tools, when you see a currency falling with extreme weakness, followed by the counter trend move with no strength, extreme weakness, no strength, these are patterns that show the trend likely to continue. Let's look at the same exact currency on a range bar. Instead of a time-based bar, this is a chart that shows X number of pips per bar. If there's no movement, there's no new bars. Let's scroll back and look at this one today. And you can really just use our intelligent trailing stop on here just for your entries and exits. When you spot, and this is a separate indicator here, build your own trend tool, which allows, it only works live because it uses multiple different time frames with different tools. Some of them measure direction, some of them measure the intensity of direction, and again you have the same exact pattern: extreme weakness, no strength, extreme weakness, no strength, and it becomes very clear how to trade this. So again, short, small, 40, well, that's a 40 pip profit right here, loss, short, profit. Obviously this isn't much of a pullback. You're going to increase your odds by waiting for a little bit of a pullback before going short. You can see short right here, loss, short right here, 15 to 25 pip win, short right here, 40 pip win. And this is a 3.0 band. This price is 95% likely to be an area where the price is going to reverse. When it gets underneath there, you really can do some aggressive counter trend buying by drawing your trend line over there or using the trailing stop to get in. You have a small profit here, right here. You would have bought at 48, out at 61, so about 10 pips. Pullback right here, not much of a profit. In right here, about a break even. Long right here, small 5 pip loss. Long here, maybe 8 to 10 pips. So when it's underneath there, you can aggressively go the opposite direction. So the Australian was one of the very high probability trades. Let's scroll back and look today. The euro is weak on all time frames, which is a positive. You have a lot of weakness right here at around midnight, followed by only about 15 minutes of strength with one 5-minute bar of extreme strength, and the next bar goes red. So coming up to about 12:45, the dollar's strong, the euro's weak on all time frames. You could consider looking for buys in the euro dollar. Let's take a look at this. I'm going to move this chart over here. Alright, So the dollar is one of the strongest currencies. The euro is a very popular currency to trade. It's right near the lower band. Short right here, small profit. Short right here, maybe 5 pip loss. And again, you're better off waiting for either a half an hour to 2 hour sideways range, or at least a 15 to 25 pip pullback. These are very tiny pullbacks. You're better off waiting for it to break the low, small profit. When it does break the low and then kind of go sideways and then down again, you can go short again, but only on the first time. Here at 83, you're short. Out here at 55, so that's a nice profit. Here you have a nice decent 25 pip pullback, short again 73, out at 45, and again when they're underneath the lower containment band, most of the time they're going to stop at the 1.382 fib. So don't be stupid. Get out of at least half your trade here at 32. The other half, when the trailing stop got hit at 43, your average exit somewhere around 35 to 37. So that's how you use our tools in combination with Fibonacci, support resistance areas. Use a currency meter to find the strongest trend. You can use our range charts, build your own trend tools that fit your style of trading. And this also, the intelligent trailing stop lets you set whatever statistics you have down here and there as well. If the market is extremely weak, it has a wide stop. If it loses its weakness, it tightens the stop. If the market moves statistically too far, it also tightens its stop. So it's very intelligently, it's the most probably complex trailing stop you'll ever find in any kind of retail platform out there, and it lets you set it based on your needs. So after a couple days of using it, most traders have told me that they've found settings that are ideal for the style of trading that they do and the time frame that they're on.